Welcome to Meow Money, where we turn tricky finance into fun, bite-sized tips. Let's dive in.
Ever seen a cat walk along a shaky fence? Tail up, calm, and graceful. She knows it's just a wobble, not a fall. That's exactly how we should see the market's ups and downs. Because volatility isn't risk, it's just movement. So what is risk? Risk is the real danger, the chance your money won't do what you need it to. Sometimes it's out of your control, like recessions, inflation, or sudden policy changes. But sometimes it's inside us. Panic selling, not saving enough, or giving up too soon. Volatility, on the other paw, is normal. It's the market breathing. Prices rise and fall. Like in the 1970s, oil shock, the 2000 dot-com burst, the 2008 crisis, and 2020's quick dip and rebound. The wiggles feel scary, but they're what keep markets alive and growing. Here's the part you can control: how you react. Let's test your inner investor cat. When your portfolio drops 15%, do you sell, hold, or buy more? When markets shake, do you lose sleep or nap through? Need this money soon or years from now? Knowing your risk tolerance keeps your plan from clawing back at you. Because volatility is just the wiggle. The real risk is walking away from the journey too soon. So find your comfort zone, trust the process, and let compounding do the purring.
Thanks for watching Meow Money. Like and subscribe to keep your savings purring. See you next time.